If you don't find a way to make money while you sleep, you will work until you die. That timeless warning from Warren Buffett has never felt more urgent than it does today. Right now, the global market is a chessboard of uncertainty, geopolitical tensions rising, tariffs reshuffling supply chains, and central banks walking a tightrope between inflation and stagnation. Investors are on edge, watching volatility creep into every corner of the market. Some are paralyzed, others are playing defense, but the smartest players, they're repositioning for income, strategically, decisively. Because when chaos reigns, cash flow is king. In times like these, legendary investors, from Buffett to Howard Marks, have consistently emphasized one core principle: always have a portion of your portfolio that pays you to wait. Not just speculative upside, not just paper gains, but actual income, steady, compounding, and reliable. This is the foundation that allows you to weather any storm and still grow richer while you sleep. And the timing couldn't be better. With interest rates finally stabilizing, inflation cooling, and valuations resetting across the board, income-generating assets are stepping into the spotlight. As billionaire investor Ray Dalio recently noted, we're in a new paradigm where those who can preserve and compound real income will come out ahead. In other words, while others are chasing momentum, smart money is chasing yield. In this video, we're diving into 3 powerful dividend stocks that aren't just surviving in this market, they're built to thrive. These are companies with fortress balance sheets, consistent payouts, and strategic advantages in sectors poised for resilience. Let's get into the names that can turn uncertainty into income and income into long-term wealth. First on the list is a true legend among dividend stocks, Realty Income Corporation, ticker symbol O, also known as the monthly dividend company. And that's not just clever branding, it's a title earned with over 661 consecutive monthly dividend payments and 111 straight quarterly dividend increases. In a world where consistency is rare, Realty Income has built a fortress of reliability that investors trust, especially during turbulent times like these. Realty Income's business model is simple, yet remarkably powerful. It acquires high-quality commercial real estate and leases it out using long-term, triple-net agreements, where the tenant covers taxes, insurance, and maintenance. These leases average over 9 years in duration, providing incredibly stable and predictable cash flows. This is what gives Realty Income its resilience. Even during market crashes like the 2008 financial crisis and the recent inflationary shockwaves, the company outperformed the S&P 500 in drawdowns, showcasing its defensive strength. But here's what makes this moment exciting. With interest rates elevated and public equity markets undervaluing REITs, Realty Income is adapting. Instead of relying solely on issuing common shares to grow, the company is now tapping into private capital, a strategic move that unlocks access to billions in fresh investment opportunities without diluting existing shareholders. According to CEO Sumit Roy, this shift could dramatically accelerate growth, with management already eyeing over $20 billion in underwritten deals. This transition allows Realty Income to keep its acquisition engine running at full throttle, even when public markets are stingy. The result? A faster-growing portfolio, stronger earnings, and greater potential for dividend increases. At a time when geopolitical tensions, tariffs, and economic uncertainty are causing panic, Realty Income offers something rare: monthly income you can count on. It's not just a stock, it's a cash flow machine designed to deliver financial peace of mind. And as the company pivots towards smarter, more flexible capital sourcing, it's positioning itself not just to maintain its track record, but to elevate it. Next up is AT&T Inc., ticker symbol T, a household name with a dividend engine that's quietly getting stronger. While this telecom titan has faced its fair share of challenges over the years, its latest move suggests that the company is finally turning the corner and turning volatility into long-term opportunity. AT&T just delivered a solid second quarter, beating expectations on both revenue and earnings. Even though fiber subscriber growth slightly missed estimates, the core business showed real momentum, fueled by higher mobility and wireline revenues, and a sharp increase in net income from $3.9 to $4.9 billion. This isn't just a company treading water, it's one making strategic progress under the radar. And the story gets even more compelling when you look at the cash flow. Free cash flow rose to $4.4 billion in Q2 alone, and the company expects this number to climb back to $18 to $19 billion annually by 2026. That gives AT&T breathing room, room to reduce its debt, buy back shares, and yes, potentially raise its dividend again after holding it flat since 2022. With a current payout ratio of just 54.6%, the dividend is not only secure, it's got room to grow. Debt reduction is another bullish tailwind. AT&T trimmed billions off its balance sheet over the past year and is now sitting on $10.5 billion in cash. At a time when high interest rates and tariff risks are weighing on leveraged companies, this type of disciplined deleveraging sends a strong signal. What makes AT&T especially attractive right now is the mismatch between perception and potential. While some investors remain cautious due to past missteps, the fundamentals are improving fast, and the stock still trades at a relatively low earnings multiple. As macro pressures begin to ease and the company leans into cash savings and fiber expansion, the path forward looks brighter. For income-focused investors seeking stability, upside, and a well-covered dividend, AT&T is once again worth a serious look. This isn't just a turnaround story, it's a cash flow comeback. Finally, let's talk about a high-yield opportunity that may not be for everyone, but for those willing to embrace calculated risk. TriplePoint Venture Growth BDC Corporation, ticker symbol TPVG. TriplePoint offers one of the most eye-catching dividend yields in the market today. TriplePoint is a business development company that specializes in providing growth capital to venture-backed startups, primarily in tech, healthcare, and other innovation-driven sectors. With a jaw-dropping dividend yield of over 16%, it's no surprise that income-focused investors are taking notice. But behind that massive yield is a story of recovery, strategic recalibration, and potentially significant upside. Over the past 2 years, TPVG has faced headwinds. Its asset base shrank from nearly $980 million in 2023 to $763 million by the end of 2024, largely due to deleveraging during periods of credit stress. While that naturally caused earnings to dip below dividend levels, management made the right long-term move, reducing leverage to preserve flexibility and avoid deeper trouble. Today, however, the company is back on the offensive. In Q1 2025, TPVG funded $50 million in new investments, almost double the quarter's starting pace, and plans to scale further in the coming quarters. The key now lies in re-leveraging up to their target range of 1.3 to 1.4x. If TriplePoint continues deploying capital and pushes net investment income back above the current $0.30 per share dividend, the market may respond with renewed confidence. Even if management were to scale back to a more conservative 25-cent quarterly dividend, investors buying at current levels would still be locking in an ultra-attractive yield near 14%, a level most BDCs don't come close to offering. Yes, this is a higher-risk income play, but TPVG's deep discount to book value already reflects those concerns. And if the company successfully proves dividend coverage in the coming quarters, the reward potential is substantial. For bold investors seeking income in a market riddled with macro headwinds, TPVG stands as a speculative but potentially powerful addition to an income portfolio.